Good morning, everyone, and welcome to the Morning Bell. I'm Robert, and it's Friday, January 30th, 2026. We've got quite a week to wrap up here with some notable developments across markets. Joining me, as always, are Lizzie, our trading specialist, and Steve, who keeps us honest with the economic data. Let's dive right in. Lizzie, we're seeing some interesting shifts this week, particularly around the Federal Reserve. What's catching your attention?
Thanks, Robert. Well, the big story that's dominating conversations is the Trump administration preparing to nominate Kevin Warsh as the next Fed chair. This is significant because it could signal a real shift in monetary policy direction, and markets are already reacting. We saw precious metals take a beating, with silver plummeting 15% and gold falling 7%. That's a substantial move that's dragging down miners and related ETFs. The dollar debasement trade that many investors were banking on is suddenly looking questionable if Warsh takes the helm.
That's a major development. The timing is interesting too, with Trump saying he'll announce his Fed pick this morning. How are you reading the market's interpretation of what a Warsh nomination might mean?
Markets seem to be pricing in a more hawkish stance, or at least less accommodation than some were hoping for. The precious metals sell-off tells us that investors who are positioned for continued dollar weakness are reassessing. On the flip side, we're seeing some bright spots in energy. Both Exxon and Chevron beat earnings estimates, with Chevron hitting record production levels and seeing upside potential in Venezuela. That's providing some stability in the energy sector, even as other areas face pressure. The broader theme here is divergence. You've got commodity volatility, with cocoa slumping below $4,000 per tonne on weak demand, while crude oil dynamics remain relatively supportive for the majors.
And we can't ignore what's happening in tech. Apple reported a 16% sales surge on strong iPhone demand, which is providing some support to the broader market. But there's definitely this sense of rotation happening.
Absolutely. The Apple numbers were solid, but we're also seeing some concerning moves in AI stocks selling off, which contributed to Bitcoin's weakness down to 83,000. There's this risk-off sentiment creeping into certain pockets of the market. What's particularly interesting is how different sectors are responding to the same macro backdrop. Housing market uncertainty is weighing on consumer sentiment around refinancing and purchases, yet the big banks and energy companies are showing resilience. For traders, this creates opportunities if you're selective and not just buying the broad indices.
That selectivity is going to be key going forward. Steve, let's get into the economic numbers. We've had several important releases this week. What's the picture looking like?
Thanks, Robert. Earlier this week, we saw some important data points that are shaping the narrative heading into February. The Federal Reserve held rates steady at 3.75% on Wednesday, which was exactly in line with expectations and marks the second consecutive meeting at this level after the December cut from 4%. Initial jobless claims came in Thursday at 209,000, slightly above the forecast of 205,000 and just below the prior week's 210,000, suggesting the labor market remains relatively stable but perhaps showing minor softening. We also got manufacturing data with durable goods orders on Monday showing a strong 5.3% increase, well above the 3.7% forecast and the 2.1% previous reading. That's a positive signal for manufacturing activity. Trade balance data released yesterday showed the deficit widening to $56.8 billion, significantly larger than the $40.5 billion forecast, which indicates imports are outpacing exports by a considerable margin. Factory orders also came in strong at 2.7% versus the 1.6% forecast, reinforcing that manufacturing demand is holding up better than expected. Now, today we're getting the Producer Price Index, which is a high volatility inflation indicator that measures the average change in selling prices received by domestic producers. This affects sectors like industrials, materials, and energy directly. The forecast is for 0.2%, matching the previous month's reading of 0.2%. What's interesting here is we've seen relatively stable PPI readings over the past several months, with the index at 0.2% in January, 0.1% back in November, and 0.3% before that. This consistency suggests producer-level inflation is moderating and stabilizing, which would be welcome news for the Fed as they consider future policy moves. If we see a reading above forecast, it could reignite inflation concerns and support a more hawkish stance, especially relevant given the Warsh nomination news. A reading below forecast would give the Fed more flexibility. The markets will be watching this closely because any surprise could impact rate expectations and sector rotation, particularly in those industrial and material stocks that are directly affected by producer pricing power.
That PPI number is definitely one to watch today. Lizzie, let's shift gears to value opportunities. What's looking attractive right now from a value investing perspective?
Robert, I want to highlight the Travelers companies, ticker TRV, which is scoring an 85 out of 100 on value metrics right now. This is a solid insurance play that's currently trading at $284 with a market cap of $63 billion. Let me walk through why this looks compelling. The PE ratio sits at 10.36 with a forward PE of 10.06. Which is quite attractive for a company of this quality. You're essentially paying about 10 times earnings for a well-established insurer. The price-to-book ratio is 1.88, which is reasonable for the insurance sector, where you want to see companies trading close to or slightly above book value. What really stands out is the return on equity of 20.7%. That's strong profitability and efficient use of shareholder capital. The company is generating solid returns on the equity base, which is exactly what you want to see in a value investment. Now, the dividend yield is 1.55%, which isn't spectacular, but provides some income while you wait for the value to be recognised. Here's where it gets really interesting though. The PE ratio, which measures the PE relative to growth, is 0.44. Anything under 1 is generally considered undervalued. So 0.44 suggests this stock is significantly undervalued relative to its growth prospects. The profit margin of 12.88% shows operational efficiency, and the debt-to-equity ratio of 28.17 is manageable for an insurance company.
Those are compelling metrics. What's your take on why the market is undervaluing Travelers right now?
I think it's a combination of factors. Insurance stocks often get overlooked during bull markets when investors chase growth, but they provide stability and consistent returns. With the current market uncertainty and potential Fed policy shifts, investors might be rotating into these more defensive, value-oriented positions. The strong ROE, combined with that low PEG ratio, suggests the market hasn't fully priced in Travelers' earnings growth potential. For value investors looking for quality companies trading at reasonable multiples with solid fundamentals, TRV checks a lot of boxes. The risk-reward here looks favourable, especially if we see continued market volatility, where defensive sectors tend to outperform.
Solid analysis. Now let's talk about our stock of the day. What are you looking at?
Today we're focusing on Lloyds Banking Group, ticker LLOI, on the London Exchange, currently trading at $108.10. This is one of the UK's largest retail and commercial banking institutions, and it's had quite a remarkable run. Let me give you the full picture here. Looking back over the past year, Lloyds has delivered an exceptional 73.49% return. That's nearly doubled from its 52-week low of $60.30 to where it sits now at $108.10. Which is actually the 52-week high. The stock has had tremendous momentum, clearly benefiting from higher UK interest rates, improving net interest margins and improved sentiment around UK banking sector stability post-Brexit. Year to date, we're seeing continued strength with an 8.93% gain, so the momentum is carrying into 2026. Now here's where it gets interesting from a valuation standpoint. The trailing PE is 15.44, but the forward PE is 9.13. That compression implies analysts are expecting roughly 68% earnings growth, which is substantial. The analyst consensus shows a buy rating from 18 analysts covering the stock, but the target price is $105.56, which is actually 2.35% below the current price. So we have this interesting dynamic where the stock is trading above analyst targets, but still carrying a buy recommendation.
That's an unusual setup. How do you interpret that disconnect between the price and the target?
It suggests analysts believe in the long-term value and likely the dividend sustainability, even though near-term price appreciation may be limited. After a 73% run, some consolidation wouldn't be surprising. The forward PE of 9.13 is quite reasonable for a quality UK bank, especially if those earnings forecasts prove accurate. However, I do want to flag some data quality concerns in the report. There's a dividend yield listed at 316%, which is clearly erroneous, and a price to book of 140, which seems extremely elevated for a traditional bank that typically trades between 1/2 and 2 times book value. Setting those data issues aside, the fundamental story is that Lloyds has been a strong performer, benefiting from the UK interest rate environment. The bank serves millions of personal and business customers domestically and is systemically important to the British economy. Looking ahead, the opportunities include continued elevated interest rates, supporting margins and UK economic stabilisation. The risks are that we're already above consensus targets. Potential Bank of England rate cuts could compress margins, and UK economic headwinds like housing market concerns could pressure loan quality. My year-end target range would be $100 to $110, suggesting flat to modest single-digit returns from current levels.
So more of a hold at these levels rather than a chase?
Exactly. Current holders should maintain positions, especially for any dividend income, once we verify those metrics. But new buyers might want to wait for a pullback to the 100 to 105 range for better risk reward. After such a strong run, patience could be rewarded here.
Makes sense. Let's wrap up with crypto. What's happening in that space?
The crypto market is facing significant pressure right now, Robert. Bitcoin has fallen to around $81,000, triggering $1.7 billion in liquidations, which is substantial. The sentiment is decidedly bearish heading into next week. We've lost that crucial $84,000 support level, and analysts are warning of a potential drop to $70,000 if support continues to fail. There are reports of a single entity potentially suppressing Bitcoin below $90,000, and we're seeing what some are calling a minor exodus that could push prices even lower. The risk-off sentiment we discussed earlier is really hitting crypto hard, with Bitcoin bleeding against both the stock market and gold. However, there are some interesting institutional moves happening. Binance announced they're converting $1 billion from their user protection fund into Bitcoin within 30 days. And El Salvador's government continues adding Bitcoin even as their central bank bought $50 million in gold. For Ethereum, the sentiment is neutral to bearish. Vitalik Buterin earmarked $45 million in ETH for privacy and open technology initiatives, which is a positive long-term development, but the broader market downturn is creating headwinds. The forward-looking factors to watch include potential regulatory changes and how Ethereum-based projects continue to develop. Solana is relatively more stable with neutral sentiment. The launch of the first JITO staked Solana ETP in Europe by 21 shares is a positive development for accessibility, but there's not enough momentum to overcome the broader market weakness.
So across the board, crypto is facing headwinds. What should investors be watching?
The key levels for Bitcoin are that 84,000 support and potentially 70,000 if we break lower. Watch for any changes in minor activity and how institutional players like Binance follow through on their Bitcoin purchases. The leverage unwind we're seeing with those liquidations suggests over-leveraged positions are being flushed out, which could eventually create a cleaner setup for a bounce. But we're not there yet. For now, the trend is bearish, and fighting that trend is risky. Ethereum and Solana might offer better relative stability, but they're not immune to Bitcoin's direction. The institutional versus retail dynamic is interesting because institutions are still making strategic moves even as retail sentiment weakens, which could set up an opportunity down the road.
Well, that wraps up quite a week. We've covered the potential Fed chair nomination and its market implications, a solid economic data picture with stable inflation readings, value opportunities in travelers, the impressive but potentially topped-out run in Lloyd's banking, and the challenging environment in crypto. As we head into the weekend, that PPI number this morning will set the tone, and Trump's Fed chair announcement should provide clarity on monetary policy direction. Thank you, Lizzie and Steve, for your insights today. For everyone listening, we'll be back Monday morning with fresh analysis. Remember, do your own research and consult with financial advisors before making investment decisions. Until next time, this is The Morning Bell.